So the last month or so, I've been seeing a lot of advertisement in people advertising how to use your tax refund from investments to pay down your owner-occupied property or home loans a lot faster. And today I want to touch a bit about on that. So the short answer is, yes, you can use your tax refund to pay down your loans a lot faster, but logistically, does it work and is it worth it? Well, it depends, right? And this is where I'm going to break it down in step by step what these property gurus and these strategists are trying to sell you. Good day everyone, I'm your host Tony Xia and thanks for joining me on another episode of The Mortgage Chat. So the last month or so, I've been seeing a lot of advertisement in people advertising how to use your tax refund from investments to pay down your owner-occupied property or home loans a lot faster. And today I want to touch a bit about on that and tell you why it might sound a little bit too good to be true. Okay, so the short answer is, yes, you can use your tax refund to pay down your loans a lot faster, but logistically, does it work and is it worth it? Well, it depends, right? And this is where I'm going to break it down in step by step what these property gurus and these strategists are trying to sell you, right? A lot of these people are trying to sell you off the plan apartments or house and land packages. So there's no special source or strategy in what these property gurus are trying to sell you. And I'm going to break it down in explaining what they actually mean by using your tax refund in paying down your loans a lot faster. Because why am I doing this? Well, a lot of these advertisements are being popped up, but they don't tell you logistically how it works, right? So first is negative gearing, right? So what negative gearing is when your expenses are a lot more higher than your income received. And whatever the difference is, you get that back on a tax return. This is generally okay if you buy an asset that has good capital growth, right? So for example, if it's going to cost me $10,000 to hold on to the property every year and the property itself grows by $50,000 every year, therefore I've got a net growth of $40,000, I'll do that any day of the week. But a lot of these property gurus that's trying to sell you this strategy and trying to sell you off the plan apartments or house and land packages, a lot of these properties are already overpriced and they may not have that growth. And therefore you're paying out that cash flow or negative cash flow for no reason, right? So let me first break it down for you why the rent more than likely will never cover the home loan repayments. So guys, right now I have a whiteboard in front of me. If you're listening to this podcast, just jump into YouTube for a little bit and watch this particular section, okay? So let's just assume they're buying a property for $600,000 and they're borrowing 80% of the purchase price, which is $480,000, okay? And let's say it's an investment loan at interest-only repayments. And I'm going to use a rate of 6% because right now, rates are around 6.5%, but we're expecting a rate drop in the next half year or so. So let's just use 6%. Your monthly repayment is $2,400, all right? Now, let's just assume the rent is $550 per week, which gives me around $2,383.33 gross per month. Now, we like to account 30% for expenses, right? Call it property management fee, council rates, water rates, insurances, etc. So we like to take 30% for expenses. And I'm actually left with $1,668.33. Now, if you're buying an apartment, I would say the 30% expense will probably increase to about 40% because you're looking at, special levies or strata, etc. All right. You can see here my net rent, take away from my repayment, I'm actually got a shortfall of $731.66 per month. Now, this is the money that's coming out of my own pocket. So remember what I said, if your expense is higher than your income, you can claim that back. And let's just assume you're on the highest tax bracket ever at 45%. Okay, so therefore, out of that $731.66, that means you can claim back $329.27 per month. Okay, but you have to understand the remainder of the 55% from that negative gearing is dead money. So you're not actually going to get that back. All right, so really, you're going to spend $731.66 out of your pocket every month just to get back $329.27. Now, if you can't afford to forego that $402.41 per month because for cash flow purposes, well, negative gearing is not the best benefit for you because you're actually foregoing that money. It's actually dead money, okay? So that's why I say to you, it's okay to do that if you can afford the repayments, if your cash flow is good, and you buy a property that's got the potential to increase in value in the long run, okay? Now, a lot of these property gurus are probably trying to sell you off the plan apartments or house and land packages, right? Look, Apartments, I don't believe in it. I don't believe in the value that it's going to grow. I don't believe in the negative gearing that you should be forking out of your own pocket to potentially get the capital growth, because we haven't seen much capital growth in apartments the last few years. But for house and land packages, I believe you can make good money from it, okay? A lot of your buyers agents out there don't believe in house and land packages for, a particular reason that they don't sell it and they only sell existing properties. A lot of your investors also don't believe in house and land packages because they believe it's overpriced. But you know what? I've made a lot of money on a house and land package. Look at areas like Marsden Park, Kellyville, The Ponds, Schofields, Riverstone, or down south, in New South Wales, call it Leppington, call it Harrington Park, call it Minto. All these areas were originally house and land package, and now they're probably doubled in price. Okay? And that's what I'm saying. You have to buy the right asset, because if you're buying an asset that doesn't grow and you're negative gearing, well, what's the point? You're paying $1 to get 45 cents back and you're foregoing that 55 cents, right? It doesn't make sense, guys. Okay, so buying the right asset is very important, but most importantly, you have to make sure you are able to sustain the net outlay of maintaining that investment property. So that tax return, what I just showed you, is one way to get your tax refund back, and that allows you to pay off your home loan faster. The second thing is depreciation. So depreciation is a paper loss, not a money loss. Okay, so for argument's sake, let's say I have a brand new house, okay, and the structure of the house loses in value, and all the attachments in the house also loses in value. But you have to understand, year on year, the depreciation amount diminishes, right? So one year you might be able to claim back $20,000. The following year you can only claim back $16,000. The following year you may only claim back $13,000, so on and so on and so on. So you can actually claim that depreciation on that property over a 30-year loan term, but the value that you can claim back diminishes. All right. So I've done a podcast with Tuan from Dual Tax. The podcast is right here. Okay. Have a look at that, or even have a look at his website. Explains a lot about how depreciation schedule works. All right. So like I said to you, it's a paper loss. It's not a money loss. Okay. So let's just use $20,000 as an example, where you can claim back on a first year at 45% tax rate. You can claim back $9,000 on the first year, which is not bad. It's a paper loss, right? So it's not actually money out of your own pocket. It's just from you claiming back the losses or the depreciation in the asset value that's lost within that asset. So at the end of the financial year, once you've completed your tax return, you can actually get back $9,000 as a tax refund, which is cash, right? So you can actually use that money for whatever purposes you want. But remember what I just said, that value of 20 grand diminishes year on year on year on year. So you shouldn't always bank on getting a big tax return back from depreciation. And remember what I just showed you from negative gearing, right? Where you can claim back $329.27, which is just under around $4,000. So you're actually going to get $4,000 as a tax refund back from negative gearing. You can actually get another $9,000 back from depreciation. So that's around $13,000 you can get back from that first financial year, which is what they are saying, that you can use your tax refund money to pay off your home loan. That's what it is, guys. Okay. But remember, you don't want to buy shit assets to do that, right? You don't want to buy assets just for the negative gearing and just for the depreciation, because the property doesn't grow, right? And with depreciation, you have to talk to your accountant a little bit more about that, because whatever you claim back as a depreciation, you actually have to pay that back to the ATO at a 50% discount. So guys, what I'm trying to say here is, yes, you can use your tax refund to pay down your loan, but logistically, you also have to make sure your cash flow is okay for sustaining that debt, right? And also that asset grows in value, because you don't want to buy an asset where you're negative gearing for no reason and you're just claiming back the depreciation, which you have to pay back 50% when you sell the property for whatever you've claimed. Okay, I'm just going to use an example for myself, right? So I purchased a brand new property at Shell Harbour area. It was a house and land. And yes, I was negative gearing, very similar to the cash flow what I just showed you and what I was claiming back in depreciation. But the thing is, the value of that property has gone from $560 when he finished building at 2018 to all the way now to around $920. So I'm okay to pay out that little bit of cash flow, right? Because the value of the property went up. But if the value of the property hasn't moved anywhere, well, you sort of have to second guess, is it worth me foregoing that 55% on the cash outlay and claiming back depreciation which I have to pay back anyway. Okay, but it becomes a bit of a headache just to keep that property. All right, I'm not saying these gurus are trying to sell you shit assets or good assets, right? But I'm just giving you a prime example of how it works and what they mean by using your tax refund money to pay off your owner occupied loan. And those two are the two things that they probably don't explain too well when they try to advertise their services. Okay, sometimes it is too good to be true, but you know what? If they sell you the right asset that grows in value, you do that any day of the week, in my opinion, in a way. Okay, so everyone, there you have it. Thanks for joining me on another episode of the Mortgage Chat. I hope you liked this video. Please give it a like, give this channel a follow, and I hope to see you on the next episode. I'm your host, Tony Xia. Peace.